Hello everyone, welcome to Blue Dragon Universe, and this is the Blue Dragon Actual YouTube channel. So today we are going to talk about this interest rate risk. We saw, one of my team members saw a advertisement on II website related to interest rate risk webinar, and he told me that you can do an webinar on this. And I actually created a video long back on SBB bank collapse. So if you have seen this video, there I also have explained interest rate risk and many other thing as well, because that was a more practical scenario. Theoretical thing would obviously be lesser than the practical scenario, so that's why I think the video was around 30 minutes long, but and I have explained multiple things. So if you have not seen that video, after seeing this video you might kind of come to my YouTube channel and search for SBB bank collapse. You can find that. So here, let us understand what is interest rate risk. Interest rate risk means whenever interest rate goes up, then that is a risk, and whenever interest rate goes down, then also it is a risk. So both side a risk, right? Sometimes the risk can be positive as well, but I mean both side is a risk, right? So who control interest rate? Now, couple of months back, I was interviewing someone, and I asked this question to a person who is a master degree holder in economics, and he was not able to tell this to me, saying that now that we are writing exam in online format, so we get the opportunity to open book and maybe Google, etc. So, but I think that is not an excuse for an master degree economic student, and if he or she is kind of interested in actuary, then that is not an excuse. You might have open book exam, but if you do not have conceptual clarity, then it's a problematic thing. So this is the exact question I've asked: who control interest rate? And he was unable to answer, and he has very good marks, right? So that's where I don't go by marks, especially for this current generation. The lack of knowledge or conceptual clarity is so intense in this generation is surprising, and I hope it improves, right? We That is the reason we have this YouTube channel. But problem is people have that mindset. Once again, if I want to clear papers, clearing papers will not get you job. Maybe in probably now you have seen the results are also out. There are so many qualified fellows, so many people that probably have also qualified or just one or two papers short. So you can see that supply demand thing emerging in the fellow zone as well, and after a while fellows would be unemployed. Like right now it is for fresher, fellows would not be getting any employment opportunity, reason being they lack the knowledge or they lack the concept, right? So that is why it's very important. Like till now you have, your mindset is such that you are focused on papers. Our education system is such that marks are given a lot of importance, passing exam is given a lot of importance, but knowledge is not given importance. But unfortunately I think in the next 2 3 years we'll see that shift happening, and which is already present in the Western countries, but in India that shift is not present. And then problem will strike many people who are at current generation, or just starting out their career with limited conceptual clarity. They already know that, and they will face very difficult to get a job or to even continue with that job. So who control interest rate risk is the central bank, which usually control the interest rate risk. In our case, it would be RBI. In US government, it is Fed, and it is also somehow controlled by the finance ministry. Usually, central bank should be an independent body. There should not be any input for the finance ministry. But in India how things work. So everything is controlled by politics. So finance ministry also control the central banks, and that is also true for not only for India but for most of the countries in the world. Ideally, it should be a independent institution. Also sometime by the global environment. Now, India is slightly aloof from the rest of the world. So when the interest rate started going up, and because of the higher inflation, so US Fed took multiple wrong decisions, and then they started hiking the interest rate. Because they started hiking the interest rate, the rupee fell, which is still falling, right? 80, it is at 83 once again. Why the rupee fell? What is the relation? I have covered that in the SB video. It would be also part of maybe whenever we are coming up with that CT7 or CB2, whatever that course is called, the economic course, or also part of the CP1 course. So whenever we come with that, it will be part of that. So I'm not going to into detail of why the rupee fell, but because of that, the rupee was falling. Like there's a free fall in rupee. I remember the finance minister coming up and saying that they do not have any level in which they want to peg the rupee with the dollar. And that's a once again that's a very wrong statement from a financial state, financial minister. I don't understand how she can give that statement. Probably lack of knowledge, but once again, because of that, the RBI was forced to increase the interest rate. Right? India did not have that, maybe probably that high level of inflation, but because US was doing that and the rupee was falling like anything, the IT industry was under a lot of problem. The pharma industry was under a lot of problem, and Indian RBI, as Indian Central Bank, has to raise the interest rate. So these are the three, maybe three factors by which who control the interest rate. I hope that is clear. Moving on, risk for the bank. Now, bank usually have long-term loans, right? Home loan, personal loan, etc., which are financed by short-term deposit because we can take our deposit from the saving account anytime, right? Even today, I took some money from my saving account, so you know that, and that's a good amount of money. So banks usually have long-term loans, right? Banks are financing their long-term loans through the short-term deposit, and that is why there is an inherent mismatch. There is an inherent asset liability problem between banks. And for bank, loans are asset, right? As compared to other companies, loans are asset and deposit are liability. So thus banks have liquidity risk and interest rate risk, and both are related to each other. How this happens will be slightly more clearer in the upcoming slides. So liquidity risk means that there are also two types of liquidity risk. Once again, I don't want to go into that, but there are two types of liquidity risk called transactional funding liquidity risk. How easily you can get funding, and the other is transaction, like whatever is your business operation, how much liquidity you are generating, and is that sufficient to take care of your liabilities, right? So if sometime liquidity risk can strike, and that might trigger a sell of your securities or investment, which will get impacted by the interest rate risk, right? And which is what happened in the SBB bank. But yeah, we'll consider that here as well. And banks also have market risk and operational risk. I just wanted to mention that so that people do not have this misconception that only liquidity risk and interest rate risk are present in bank. Bank also have market risk and operational risk. And but those are not part of today's discussion. So what happens when interest rate goes up? So bank get higher loan interest because interest rate goes up. So earlier bank might be charging 5%. Now it will charge 7%, but that is for the new loan, not for the existing loan, right? That is for the new loan or for the floating loan, right? So until unless you have floating loan or new loan, you will not get that benefit, right? So usually when the interest rate goes up, people will stop taking loans from the bank. That's how it is, right? So usually the interest rate goes up means the central bank is trying to control the inflation, so they do not want to give too much of money in the hands of the citizen, right? India government has a different thought process, though. They tax government, and in any case, inflation, non-inflation, they always take disposal money out of your hand. So that's how India government works. But usually hiking the interest rate means that inflation should be controlled, right? But banks also pay higher interest on deposits. So that means that overall net interest margin should improve, right? Because you are also paying higher interest on deposit, you are also getting higher loan, but this should obviously be higher than this one, right? The loan should be higher than the deposit, or the interest on the loan should be higher than deposit, and the net interest margin should improve, right? So that should mean that a bank should have more cash flow, and which is once again in sync with what central bank wants, that the disposable income should be less with the uh, people or the citizens, right? So banks are mostly invested in short-term securities because they cannot go into long-term securities because somewhere someone can withdraw, right? Like today, I withdraw a big amount from the bank, and that's why they would usually invest in short-term securities so that they can easily encash those, right? So those securities has to be liquid. And with interest rate, increase in interest rate, the price of the security decreases because there's the inverse relationship, right? If you remember the pricing of the bond, the yields goes in the discounting or the denominator, and price is the numerator, right? So that's how there's an inverse relationship. The more the yield increases, the price decreases, and vice versa. So banks have unrealized loss, right? So in this case, the banks have unrealized loss, which happened with SBB Bank. And whenever there is some liquidity crisis, like in such situation, if you try to get money from the bank, suppose I have 2 CR placed in my saving account, and I decide to withdraw all the entire 2 CR. So bank will also have to liquidate their savings or liquidate their, whatever securities or investment, right? And because of this high interest rate and the rise in the price of the security being lower, they have to accept or realize a massive loss. And because of that massive loss, a liquidity crisis can trigger a massive bank run. Bank run means multiple banks goes bankrupt, right? So that is what is called bank run. And I think now you catch the picture how liquidity risk is related to the interest rate risk, right? So when interest rate risk goes up, and if it goes up significantly, then this can happen. If every person, want to kind of withdraw their saving account or saving, saving account money, right? But usually that should not be the case because your saving account is getting higher interest. So you don't want to you want to keep that money in the bank. That is the purpose by which center or the reason for which the central bank has increased the interest rate. But sometimes reverse might happen. People, have different psychology, different thought process. If you cannot take loan, then you probably would like to take or make use of your savings, right? So that's why you might want to withdraw from your bank. And the reason because of that, a liquidity crisis for the bank can trigger massive loss because they have to liquidate their securities, right? What happens when interest rate goes down? The reverse will happen, obviously, right? So banks get lower interest rate and also pay lower deposit. So overall, the interest rate margin should decline. In this case, earlier it was increasing. In this case, it is declining. So in any case, this is not good for the bank. Their margin is declining, which is currently the situation. Most of the banks will see decline in their margin. Banks are invested mostly in short-term securities, which are susceptible to interest rate movement. Why it is more susceptible to interest rate movement? I leave that to you. I want someone to or many persons to comment, right? And if someone can take a shot, I can, or the team can maybe rectify that answer or or accept that he or she is kind of giving the right answer, right? Why it is more susceptible to interest rate movement? Why short-term securities are more susceptible to interest rate movements? That is the question. Now, but for our purpose, let us assume that it is susceptible to interest rate movement. So, decrease in interest rate, the price of the securities increases, and banks have unrealized gain. Now, this time banks have gain, right? Earlier banks have losses. This time bank have gain. So that is a good thing for the bank, right? Our bank may not be able to realize the gain, accepting or expecting further up move, right? Which is what happens when there is, you are seeing some good money, you want to hold it for longer period of time, right? And it also depends on when the securities are bought because banks are in, kind of short term nature. So it is possible that banks have just purchased the security 1 month back, and that at that point of time the interest rate was actually pretty low. So right now, although the interest rate is lower than when the bank has, kind of purchased, but the increase in the price is not that significant. Why this happens? Because banks mostly invest in short-term securities, so do not have long-term securities where this, this gain will be more pronounced, right? Because you have invested in long-term securities much earlier. You have probably invested in long-term security 1 year back when the interest rate was really, really high, and 1 year later the interest rate has gone down. So there is a significant gain that you can expect because you have invested in long-term securities. But in this case, you have just invested 1 month back. The interest rate was quite low at that point of time because all this thing happen consistently. It's not that one day suddenly some central bank governor drink thumbs up and say aaj kuch tufani karte hai. That is not the case, right? So it will see a consistent decrease in the interest rate, and that is the reason for which you will not see that much of gain, right? So even when the interest rate goes down, which should favor the bank, the gain would not be that much for the bank, and the bank is losing on the interest rate margin. However, if the interest rate goes up, then it can be detrimental for the bank, especially if it is somehow it's linked with an liquidity crisis. So I hope this is clear. This is a concept that I think all of you have studied. Immunization. So protect against what is immunization? Once again, you have to kind of Google that or go back to your books. I'm not going to define or explain that. But immunization, if your asset and liabilities are kind of following the rules of immunization, then you are protected against small movement in interest rate. Sometimes also again big movement in interest rate, you are protected, right? It's a very robust process, but it is impractical. Banks will deliberately mismatch to gain, right? So they will not kind of follow the immunization principle because they want to make profit. If you are following immunization, then it is immunizing you against the profit as well as against the loss, right? So in order to make profit, you have to kind of not follow innovation strictly. And that is the reason when such situation happens, like interest rate risk arises, situation arises, banks do pay the price. And as compared to life insurance, which is long-term business, or maybe general insurance, which is also still more long-term than bank, right? So bank is more susceptible to interest rate risk, and that's why you see economy, whenever economy collapses, it is kind of, it is first the collapse happens in the banking sector, and then it will spill over to the other sector, right? So bank are very susceptible to interest rate risk because that is their business. They are dealing with interest rate, right? So that is their business, and that is why they are extremely susceptible to the interest rate risk, right? So I hope you are clear on what I kind of said, and you got an idea about that, right? So if you are not clear, then for any question and answer, obviously you can write in the comment section. I am also expecting the comment for the question that I have asked. So that's it. I hope you like this video, and do check out our courses. The website is given in the description. We are launching the IFRS 17 course. The last date for that registration would be 14th of July. We have received couple of registrations, and we have limited the number of people to 12. So there are some seats still left, and if you are interested in IFRS 17, please do purchase that course, and check the description for more detail instead of asking the team or messaging me. Check the description. All this, all the details have been given there. What type of course would be, when it will be conducted, everything would be given there, right? I have seen a tendency in actual student, once again, in the current generation of actual student, not to read instruction properly and just straight away asking for details. So that is not good. You have to, in order to do well in actual world, once again, you have to read instruction properly. So please read instruction, and if you have any question after reading the instruction, for any clarification, do message our LinkedIn page, or send us an email in the website. So we'll be responding within 24 hours. So with that, I close this video. I hope you like the video. So please hit the like button, share this channel with your friend. See you in future videos.